Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to the program. This is the Index Investing Show. Coming up on today's broadcast, gold. Overly bullish sentiment forecast, well, really foreshadowed gold's downfall. We're going to get into that. Gold has resumed its downswing. Is the worst over? 877-711-5611. We will also be doing some rocket surgery on some individual stocks. I want to focus on Yahoo because Yahoo's been in the news. This past week it hit a 5.5-year peak. Hasn't been at $30 a share in 5.5 years, and that was celebrated by our friends in the media. So before we start celebrating, let's give that peak in Yahoo's stock price some perspective. So stay tuned for that. We'll also get into some of your calls and your emails. If you would like to join us to talk about a particular stock, mutual fund, ETF, there's a lot to get into. You want to talk about Twitter's upcoming IPO? Will it fall flat on its face just like Facebook? Will it do a face plant? We'll see. I'll have some thoughts, though, for you on that. 877-711-5611. That is the number. We're here. This is a live broadcast. You can also tweet me at Index Show is my Twitter handle. And I'm going to also use some reverse psychology on you. So stay tuned for that. We always have fun playing mind games. We will be here for the next hour talking the birds and the bees of successful investing. I should have mentioned it earlier, but I'll mention it now, that my program guest will be Joe Witthohn. He's an ETF analyst. He's with a company called Emerald, and he's going to be joining us during the third segment of today's broadcast. So stay tuned for that. Joe is good people. And we're going to dig into floating rate bond funds, what those are. I also want to scrape his brain about gold and the like. 877-711-5611. That is the number. We're here. This is a live broadcast. So let's take a look quickly and see where some of the key market indexes and the financial products tracking them stand. So far in 2013, total U.S. stock market, ticker symbol VTI. Now, this is through the market close of September 13th, up 20%. So we still have the total U.S. stock market double-digit return, pretty darn good. VEA, which follows international stocks from Japan and Australia and Canada, VEA ahead by an even 11%. Emerging market stocks are still down 8.2% year-to-date, but they have made a nice little run here. Now, lest I remind you, emerging market stocks had double-digit losses somewhere in the vicinity of 15, 16, 17%. Now they're just down 8%, so they've made a little bit of a run here over the past week or two. So emerging market stocks coming back, I say it's a sucker rally. These countries don't have problems just with their local economies, but also they've got currency problems. So the run that we're seeing in emerging market stocks, I don't think it's going to stick. Ticker symbol BND follows the total U.S. bond market, down 5%. The story there is very simple, ladies and gentlemen. When bond prices fall, yields go up. And the opposite is true also. The environment that we're in right now is one of rising interest rates, which means bond prices have been falling. And that's why ticker symbol BND is down 5%. Down even more have been Treasury inflation-protected securities, also known as TIPS, TIP, down 9.5%. Why are TIPS going down? Well, they may be a hedge against inflation, but they're not a hedge against higher interest rates. And that's something that you need to understand about TIPS. Let me repeat that because that's pretty important. TIPS are not a hedge against higher interest rates. They are a hedge against inflation. We haven't had much inflation. So TIPS down 9.5%. They can and they will lose value when interest rates rise as they have been. Ticker symbol VNQ follows U.S. REITs, also known as Real Estate Investment Trust, pretty much almost flat, up 0.9%. VNQ is a rate-sensitive sector and seeing lots of pressure because of that. So VNQ, I think, will struggle and continue to struggle. Ticker symbol GLD follows the price of gold bullion. This is something we're going to talk about, how excessive bullishness in the gold and silver market did foreshadow a meltdown. I'm going to share with you some silly comments made by news media headlines in 2011. You're going to laugh when I share some of these headlines with you, and it will just show you the silliness of excessive bullishness in the gold and silver market and how it really foreshadowed what was to come, really a meltdown of sort. And yes, we are in a bear market in gold and silver prices. Ticker symbol GLD is down 21% since the beginning of the year. Over the past 2 years, gold has been dead money, folks. Gold prices down more than 25%. And I would like to talk to some of you gold bugs. Maybe I'll do some reverse psychology on you. Go ahead and buy gold, you masochistic nitwits. Buy gold, all the gold you can get. Go ahead. Because, of course, I've been telling you to do the exact opposite, haven't I? I've been telling you that we have not seen the worst yet in the gold and silver market. We have not yet seen capitulation. We have not yet seen that biblical moment described in Ezekiel chapter 7, verse 19. Read it, you heathens. What does it say? Into the streets they will throw their silver, and their very gold will become an abhorrent thing. See, that's the biblical description of market capitulation. When people just unload assets at whatever price because they don't want nothing to do with it. But we haven't yet seen that in the gold and silver market, bad as it has been, because we have these gold bug nitwits like Peter Schiff and James Turk and to some extent Jim Rogers and to some extent James Grant and the many others that have been completely wrong about this gold and silver market. And every time bullion falls 5%, they come out of the woodworks declaring to the public, oh, this is the mother of all buying opportunities. Buy gold, buy silver. And just as they pronounce that horrible advice, what happens to gold and silver? It goes down another 5%. See, this isn't the kind of market where you can buy on the dips and hope to make money. This is also not the kind of market where you can buy gold and silver at whatever prices and hope for a profit. It just isn't. 877-711-5611, that is the number. Join us. Any gold bugs listening to the show? Go ahead, call the program. Let's argue. 877-711-5611. I'm game. Ron@indexshow.com is the email address. My Twitter handle @indexshow. You can tweet the program live. We're mispronunciating words on today's broadcast. We're also going to do some rocket surgery on Yahoo, which this past week reached a 5.5-year high. I want to talk about that and give you some perspective on what that means. Hey, did you see mortgage applications dropping 13.5% in the week ending September 6th? Wow. Wow, this has been a pretty brutal run for mortgage bankers. Refinancings are at their lowest level since June of 2009 and are down a whopping 71% from May. Yikes. 877-711-5611 is the number. You're listening to the Index Investing Show. Be ready for what comes next.
The Index Investing Show with DeLegge.
I've got a tiger by the tail, it's plain to see. I won't be my twin, you get through with me. Well, I'm a losing weight and I'm turning mighty pale. Looks like I've got a tiger by the tail. Well, I thought
Oh, that so well describes the gold and silver market. I've got a tiger by the tail. And right now it looks like the tiger's winning, especially for those of you that have been on the wrong side of the gold market. I've been warning you that this moment would come. It has arrived, and we have not yet seen the worst in this market. I promise you that. But let me just contrast for you the excessive bullishness that foreshadowed this bear market that we're seeing in gold prices. Because right back in 2011, we can chronicle very closely the great gold rush from its bubble moment pretty much up to now its crash. So let me read some headlines from you from 2011 in August when gold prices peaked at around $1,900 an ounce. Here's what ABC News said, quote, "Gold rush also a boon to the refinery biz." Here's what Bloomberg said, "Gold exceeds $1,800 an ounce as investors seek to hold the ultimate collateral." Wonder if they feel that same way about gold right now, if it's the ultimate collateral. How about Forbes? Jim Rogers says gold is going higher. How about Forbes again? Gold at $1,800 an ounce is being seen as a haven. How about the street.com? Wait to buy gold at a pullback. Pretty bad advice there. How about Beacon Equity Research? Gold price poised to go parabolic. Well, it sure did go parabolic, and it went maniac too. How about moneycontrol.com? Gold gold in a portfolio is mandatory. These are some of the headlines from 2011. Chicago Sun-Times, the gold rush is on again. So what we take from this is really, these are all contrarian indicators. Whenever we see a frenzy by the masses, a frenzy by the public and by the media about a certain thing, about a certain asset class. And that was the case with gold. And of course, we don't just look at sentiment. What all of this describes is market sentiment, which in this case was excessively bullish. We also have to look at fundamentals. We have to look at technicals. We have to look at market history. And then we have to have some common sense. And that is what we do when we can pinpoint key market inflection points, turning points in the market. And when you do the opposite of the crowd, guess what happens? When you combine all of those factors that I just mentioned and you do the opposite of the crowd, usually what happens is you turn the odds of successful investing in your favor. That's what you really do. But at that time, just as today, we still have all these reasons for the gold rally to continue, even though it's not. And of course, the explanations are seemingly endless. Gold is a protection against inflation. Gold is also a protection against deflation. Gold is a safe haven during stock market meltdowns. Gold also rallies when stocks rally. Central banks are buying gold, so should mom and pop. See, these are all the explanations for why people should buy gold. And all of them have, for the most part, over the past 2 years, not been true. Not been true at all. So we're going to talk a little bit later with my program guest, Joe Witthohn. He's an ETF analyst. I want to scrape his brain about gold and see what he thinks about it. 877-711-5611 is the number. You're listening to the Index Investing Show. My Twitter handle, @Index Show. Please join us. We're going to do some rocket surgery on Yahoo's stock price, which this past week hit a 5.5-year high. I want to give you some perspective. I know the people in the media are celebrating that. Whoa, look at Yahoo. It hit 5-year highs. We did this exercise, by the way, last week on the program with Facebook, when they were celebrating how Facebook reached a 52-week high. And what we did was we slammed that opinion. We assassinated it, as we do with all consensus investment opinions. We dissect them, we cut them open, and we assassinate consensus opinions because they're wrong most of the time. And that was the case with Facebook. We looked at its performance since its IPO date back on May 18th of 2012, and what we quickly discovered was Facebook has been a stinker. It's been an absolute stinker since its IPO date, being easily outperformed, not just by stocks of its peer group and ETFs tracking that, like ticker symbol FDN, which has blown away Facebook, but we also compared it against the S&P 500, which too has blown away Facebook. And then when we compare Facebook's performance to some of its specific individual stocks and peers like LinkedIn, Facebook is just, it looks pathetic. It's a pathetic investment that hasn't done nearly as well as the media would like you to believe. Now, we've also been talking about this major investment mega theme of higher interest rates. We've got a couple of emails that we're going to get into a little bit later asking about the best way to capitalize on higher rates from this point further. The 10-year yield on U.S. Treasury bonds closing the week at 2.89%. We've already danced with 3%, and I think we're going above that. I think we're going above 3%, and we're already beginning to see certain industry sectors wither under the difficulty of higher rates. We're talking about rate-sensitive industry sectors. We already talked about REITs, ticker symbol VNQ, which have lost a lot of ground this year. I mean, they were up double digits earlier in the year. Now they're not even up 1%. So they're just barely hanging on to their year-to-date gains. Utility stocks is another sector that's seen some of its ZEP taken away. Ticker symbol XLU is ahead by 6.6% and is the worst performing S&P 500 industry sector, if you could say that. I mean, all 9 sector ETFs tracking the 9 sectors in the S&P 500 are up. So we don't have one sector in the S&P 500 in negative territory, but nevertheless, XLU, which tracks utilities, ahead by 6.6%, and it's the velocity of the gains are slowing. Mortgage applications dropped 13.5% for the week ending September 6th, and look at this. If you really want to know how much the mortgage market has taken a hit from rising rates, refinancings, according to the Mortgage Bankers Association, have now fallen to their lowest level since June of 2009 and are down a whopping 71% since May. This, to me, looks like a great setup, and we haven't seen them crumble to the fullest extent that I think they can crumble. But home building stocks, which, and there's a couple of ETFs out there, ITB, XHB. Now, there are no inverse or short home builder ETFs, so the only way you can play this is by shorting them directly or buying put options on these ETFs. But I think that's going to turn out to be a good play. In fact, it's one of the picks that we highlighted in my weekly picks at etfguide.com. If you haven't signed up, I encourage you to do that. And by the way, through the middle of the year, 78% of the weekly picks have turned a profit. The biggest winner was a 525% gainer. That, by the way, is time-stamped. I'll be happy to show them to you. Go to etfguide.com, sign up, and follow along, make money. I'm going to share with you a trade that we did that's related to gold because we've been talking about the great gold crash of 2013. And those of you that have been on the short side of this market, you've been cashing in, haven't you? This is the Index Investing Show. I'm Ron DeLegge. Coming up, Joe Witthohn with Emerald at Index Show is my Twitter handle. I'll be right back.
The Index Investing Show with Ron DeLegge.
Meet Joe Investor. He's nice and he means well, but Joe Investor always misses the really big investment opportunities. For example, Joe Investor missed last year's 16% gain in small company stocks. And the year before that, he missed the 33% gain in long-term U.S. Treasury ETFs. And what about this year? Well, like all the times before, Joe Investor once again is all about lost opportunities and missed chances. Are you always missing out, just like Joe Investor? The Profit Strategy newsletter at etfguide.com will help you to stay on top of major investment trends so you never miss another big opportunity. Join today and get a $50 bonus by using promo code JOE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started. And one more thing, promise yourself to never ever miss another big investment opportunity.
Well, the U.S. economy has economic activity that's not robust, but nevertheless growing at a modest pace. And as economist Ed Hyman said, there's not a lot of speed to the economy, but at least there's a lot of torque. Here to talk with us about that and more, Joe Witthohn. He's a certified financial analyst. He's also head of ETF strategy at Emerald Asset Management. Joe, welcome to the Index Investing Show. Great to have you with us.
Hey, thanks a lot. Thanks a lot, Ron.
Let's begin by talking about the yield on 10-year U.S. Treasuries, which has surged mightily, and bond prices, especially long-term bonds, have been getting hit. What steps should bond investors be taking to stop the bleeding?
Well, the first thing that people, in my opinion, have to understand is exactly why bonds are getting creamed, I think is the term that you used. Rates are going up, and it's not as simplistic as it sounds. There's a very important concept, Ron, known as duration. It's a coupon-adjusted number, and it gives an indication of how much a bond or a bond fund could lose if rates suddenly go up by 1%. So, for example, the duration on a 7 to 10 ETF, and I'm using the iShares ETF with the symbol of IEF, an example, is 7.5. So that means that if rates spike up by 1%, the fund will have expected to have a 7.5% loss. So if the 10-year moves from 3%, around where it is now, up to 3.5%, this fund would lose 3.75%, and it'd be expected to. So duration is a function of the years to maturity. So a 20-year bond will have a heck of a lot more duration than a 10-year. Yeah, you get higher yield, but you also undertake more risk to get it. And to stop the bleeding, if your rates will pop, probably you'll want to keep your duration shorter. So you'll want to use a 3 to 7 year, because that'll only down about half as much.
Makes total sense. If you're just joining us, you're listening to the Index Investing Show. We're pleased to have with us Joe Witthohn. He's CFA and head of ETF strategies at Emerald Asset Management. TeamEmerald.com is the URL. Now, what about this idea, Joe? What about bank loan ETFs like the Spider Blackstone GSO Senior Loan ETF, that's ticker symbol SRLN, which adjusts as rates increase? Good idea or bad?
Fair. And it's a fair idea because on paper they seem extremely good because the senior loan funds, these things are first in line when it comes to getting your money back. But one of the ones that I pulled as an example, Ron, was one with the symbol of BKLN. And what I looked at for BKLN, which is one of these other bank loan funds that's put out by PowerShares, I went over the monthly returns, and I noticed that back in August of 2011, when the credit quality was under question for all banks, this lost 6% in 1 month. So this fund has a great record over time, but if you could stand with the occasional volatility, it would be fine. But I don't think a lot of investors were really looking. I think a lot of investors would have panicked if they saw that they lost 6% in a very, very quick period of time. And these things do have some risk involved with them.
If you're just joining us again, we're pleased to have with us Joe Witthohn. He's with Emerald Asset Management, head of ETF strategies. Aside from rising interest rates, Joe, the great gold crash of 2013 is another major investment theme. What is your view about precious metals? Do you think prices have bottomed?
Oh, I love the question about gold because I'll tell you, quite frankly, I have no idea. And I don't think anybody else does either. I mean, some people think that gold is the silliest investment in the world. I mean, does it really protect against inflation? I keep hearing that when I hear these radio ads to buy gold, but there's no proof in that at all, especially lately. I mean, gold is down 16% this year. Does that mean inflation dropped by 16%? I don't think so. You know, gold was up 30% in 2007 and in 2010. Now, did prices rise by that amount? No. You know, it was mostly speculation. The best thing I can mention is that I hear the argument, and I get this all the time, that physical gold is great because in case of, I don't know, a complete disaster. Let's think of the poor guy in Fukushima following the tsunami, and he has gold in his house and he needs a loaf of bread. What will he do? I mean, will he go to a neighbor's house and try to pawn off his gold stash or slice some little shavings off the top in return for food? I mean, not at all. The neighbor and everyone for miles around would be in the same sinking boat. So I see gold as an emotional buy, and I stay away from it, really. I do. I'm a little bit nervous because I've never really understood it, and I never think I will.
The other thing about gold, too, if you look at its historical performance, it has very long periods of boom and bust. For example, from 1980 to, I think, around 2007, I mean, it didn't really do anything for, 27 years?
Sure, and in 1980, and I'm glad you mentioned that because I was in college at the time, and everybody was getting ready to cash in their high school class rings and get gold, and then they heard that gold was going to go from 800 back then to 5,000, 6,000 people were talking about, and what did it drop down to? I think like 250.
Yeah, something like that. I don't know the exact figure, but it was ghastly. And it didn't do anything for years. And, of course, too, people sat on that, and they collected no dividends. They collected no earnings because gold has none of that. If you're just joining us, you're listening to the Index Investing Show. Pleased to have with us Joe Witthohn. He's the head of ETF strategies at Emerald Asset Management. Now, sector-wise, healthcare stocks, ticker symbol XLV, have been good performers within the S&P 500. Really the top performing sector thus far year to date within the S&P. What's going on with healthcare, and do you like this particular sector?
Yeah, actually, Ron, and I like that sector very, very much. And the main reason is because of the demographics, not only of the United States but also the world. I mean, there was a report I wrote about yesterday morning that showed that I think the number was about 114 million Chinese are expected to have diabetes in the relatively near future as they get older, because we do live in an aging society. We're going to have more people in the world. There's no kidding aside about that. We have something in the order of it's about 7 billion people right now in the world, and they're expected to have 9.3 billion by 2050. I mean, what are we going to do? We're going to have to feed these people, but they're also going to need health care. And the demographics of it, especially in the United States, are that, people are going to need it. Every morning I get up, I'm thankful because I have gout. Well, I'm not thankful because I have gout. Thankful because I have allopurinol. I sit down and I take this pill, and oh my God in heaven, I can go out tonight and have some red meat and red wine, some meat and red wine, and I'm not too worried about having another bout of gout.
Yeah.
So I think a lot of people are in the same type of boat with a lot of maladies, And I really think that healthcare is going to continue to be a great sector to be in, especially with some of the advancements going on in science in the relatively near future to come.
One last question before you take off. Many of our listeners like the consistency of dividend income. What areas of the market do you think offer good opportunity for dividend investors, if any?
Well, yeah, and there's no kidding aside. I'm absolutely in love with dividends just because of the pure mathematics of it. There are some great ETFs out there. There's one by Morningstar, which has a symbol of VIG, which is a dividend appreciation. So what that does is it tracks the performance of the NASDAQ U.S. Dividend Achievers Index. And what happens, they invest in companies that have a record of growing their dividends year after year. Because if you have a dividend you're comfortable with, and that dividend is growing at or a rate of inflation, you're going to be covered for future prices. I mean, if you're getting $4 a year, inflation's 3%, and you're getting another 3% on top of your dividend coming up next year, you've covered the rise in prices. So I'm very, very much a fan of dividends.
Yeah, and that ticker symbol is VIG. That's the Vanguard Dividend Appreciation ETF. Joe, great ideas, great interview. Thanks for joining us, and we hope to have you back soon.
You're on. I look forward to seeing you again at some point. Take care, and thank you very much.
Again, that was Joe Witthohn, Emerald Asset Management, head of ETF strategies. This is the Index Investing Show. More when we return. I'll be right back.
The Index Investing Show with DeLegge.
All right, let's do some rocket surgery. If you're just joining us, you're listening to the Index Investing Show. 877-711-5611. That is the number. We're here. We're live. We're talking the birds and the bees of successful investing. And where does that begin? Well, with a low-cost portfolio of index funds and index ETFs. Really the same beast. ETFs are my favorite way to play it, and of course we stick with the ETFs that have the lowest expense ratios and that also offer broad market exposure. That's the foundation of your portfolio. Now beyond that, after you've built that foundation, if you want to get involved with a specific industry sector ETFs and accentuate your portfolio, that's fine. Also, if you've got some extra trading capital and you want to make strategic moves in the market, like I'm going to explain to you in a minute, you can do that. So these are the ways that you go about building a rational investment plan that will help you to build your net worth and reach your investment goals. Now, if you'd like to get a portfolio report card to see how your investments are really performing, I will do that report card for you. Ron@indexshow.com is the email address. Get in touch with me. I'll grade your investment portfolio right on this program. I'll give you either a passing grade or a flunking grade, depending on how your portfolio looks in 5 key areas. I look at cost, I look at diversification, I look at risk, I look at tax efficiency, and then I look at the bottom line, which is market performance. How has your investment portfolio performed over a particular period of time versus key benchmarks like bonds, like stocks? How have you done? So if you want to get your free portfolio report card, get in touch with me. I'll do that for you. We'll feature your very own investment portfolio on this broadcast. We do that too, by the way. We do protect your privacy. We do not disclose any personally identifiable information, so we keep it generic that way. But at the same time, we do dissect your holdings, we look at the value of your portfolio, and we discuss it openly so as to educate you about the reality of your current investments. And also we do this to help the rest of our audience, your fellow listeners, so that they too can understand how to build a rock-solid investment portfolio. 877-711-5611 is the number. You're listening to the Index Investing Show. I'm Ron DeLegge. I am also the publisher and editor of the ETF Profit Strategy newsletter. It comes out every month. If you have not yet picked up a copy, go to etfguide.com and do so. Let's get into some of your emails. Dear Ron, which is a better ETF to short long-term bonds? Ticker symbol TBT or TMV? Signed, Chester in Houston, Texas. And ticker symbol TBT is, for our listeners out there that are not familiar with this is the ProShares Ultra Short 20-plus year Treasury Bond ETF. So it aims to short long-term U.S. Treasuries, and it does the same thing, Chester, as ticker symbol TMV, which has that same strategy of shorting long-term U.S. Treasury bonds. But the difference between the two is TBT uses double or 2x daily inverse performance, whereas TMV uses triple daily inverse performance or leverage. So TBT has 2x or 200% leverage inverse. TMV has 3x or 300% daily inverse leverage. So the real question is not which one is better, because they both do the same thing, Chester. But the question is, do you want more leverage or less leverage with this particular trade? Do you feel strong about shorting long-term U.S. Treasuries? Do you think that the next wave or next move is going to be just as big, if not bigger? And if you think it is, then, well, I would probably err on the side of the more highly leveraged fund, because you'll get more bang for your buck. TMV, which aims for triple opposite daily performance. So that's really the way it works. And these are both short-term trading instruments. They're not meant to be bought and held. And TMV, just to give you an idea in terms of performance, market performance, and just how much interest rates have really, rising interest rates have really hurt long-term bond prices. TMV over the past 6 months has jumped almost 23% in value. Just a huge, huge move. So TMV is on a roll, up 23%. And over that same time frame, TBT, which, as we just explained, does the same thing, but it uses double inverse leverage to long-term U.S. Treasuries. TBT ahead around 17%. So that kind of explains the differences there. Let us know how it works out, Chester. Dear Ron, regarding ticker symbol GLL, just wondering how you think it will play out given the bounce in the close of the gold ETF, GLD. GLD itself is below 130, and it's reflecting panic, if I'm reading the chart correctly. I did not invest in GLL, although I did invest in ticker symbol DUST. I bought 500 shares at $27 a share. I bought 500 shares at $30.50 a share, and I'm pleased to say it closed at almost $35. And I've been raising the stops for every session, and my current stops are at 34. My question is, do you think gold can go higher this week, or do you think it's range-bound going into the FOMC meeting on Tuesday? Your thoughts, always appreciated. Mike from Australia. And Mike actually is a subscriber to the ETF Profit Strategy newsletter and our weekly picks. And for the week of September 4th, we told subscribers that it was time to short gold. And we recommended ticker symbol GLL as the way to do that. We also had a tandem trade on options, put options for GLD. So we do both options along with the ETF itself, but this is a good way to play it. Mike substituted DUST instead of GLL. Now, DUST aims for triple daily opposite performance to gold miners stocks, whereas GLL is actually a double inverse to gold itself. And really, you're doing it the right way. You want to raise your stops whenever you have a profit on paper, because you don't want to lose those profits if the ETF reverses. And on gold being range bound, I think that's probably my best guess in the super short term. But I will say this, that the Fed's slowing of quantitative easing is not at all bullish for gold itself. And we are just in the beginning period of that slowing of quantitative easing. We're going to see less and less quantitative easing forthgoing. And certainly that's not going to be good, I don't think, for gold. But of course, again, we follow prices. Prices are a leading indicator. We don't follow hunches. We don't follow opinions. We don't follow our gut. We let prices be a leading indicator. And that, by the way, explains how we've been able to be on the right side of this market. That trade, by the way, on GLL, we recommended it at about $82 a share. It has since popped to just under 90. It's been a really, really good trade. If you'd like to send me a question, comment, email, send it to ron@indexshow.com. Also on Yahoo, rocket surgery. Over the past 5 years, Yahoo has been dead money, folks. Yahoo has underperformed QQQ, that's the NASDAQ 100. It's also underperformed not just its broad peer group, but it's also underperformed XLK, which is the S&P Technology ETF. So there's your perspective. There's your rocket surgery on Yahoo. That does it for another episode of the Index Investing Show. If you want to read my articles and my newsletter, go to etfguide.com. Join us again next week, same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.